Hey, it's great to be with everyone. We've all been interested in the stock markets recently and have had animated discussions on our Slack. Thanks, Trips, for deciding to making this roundtable discussion that we usually have about this topic. I think it interests everyone here. So, who wants to kick off then?
Let me start. Let me start by asking the most basic question. A
Yeah,
term which has had a very negative connotation to it, a negative vibe to it, short selling. What does it mean, and how does one decide which stock to short sell?
yeah. I mean, that's the nugget, isn't it? If an investor thinks that the price of a stock will fall, he or she can borrow the stock with the promise to return the stock at a fixed time in the future. So the investor will sell that stock that he's borrowed in the market and buy it back before expiry of his short. That effectively is short selling. He or she is hoping that the price of the stock will fall in that period, thus netting him a gain. It's a risky strategy because if you think about it, the lowest the price can go is zero, right? But there is no ceiling to how high it can go. And we've seen that as a live example recently over the last few days. And that's why I think this particular episode that's happened in the equity markets is hugely educational as well. The fair value chatter that people seem to rely on holds less and less value, in my opinion. Now, short selling sort of has these connotations. Is it legal, right? So it isn't illegal in the US. And you have to understand what happens when an investor shorts the stock. The title to the stock changes hands to the borrower for that period of time. So technically, there is an actual underlying that is being sold. However, like I mean, we all are experienced in this. We all know how creative finance can be. So derivative contracts make it possible to multiply the impact of the short, making it possible to profit from a short position larger than the actual shares borrowed. And that's, I think, been the problem in this case as well. So, is short selling free of cost? Is it just about borrowing it and buying it back at a lower price? No, there are costs related to shorting. Short sales can be made via margin accounts, and margin interest can be a significant expense. The interest payable on short trades can add up over time, especially if short positions are kept open over an extended period. Shares that are difficult to borrow have also an additional cost called hard to borrow fees that can be quite substantial. The short seller also is responsible for making dividend payments on the shorted stock to the entity from whom the stock has been borrowed. The short seller is also on the hook for making payments on account of other events associated with the shorted stock, such as share splits, spin offs, bonus share issues, etc. Because remember, technically, the person owns the stock, the title transferred, and then he sold the stock. So he is responsible for incurring all the costs relation to the stock.
Tell me something. GameStop, I mean, as the name suggests, gaming related company. Given I think the backstory of the pandemic over the last almost 12 months, the need for recreation, all of that, I would assume that is not a stock you expected to fall off a cliff. How come the short sell in GameStop?
So GameStop is a physical only retailer in America. It sells games, consoles, and other electronics in American malls. To be honest, it's not anything new and exciting, as you say. But and in fact, if you think about it, it wasn't doing very well before the pandemic. And because of the pandemic, its performance was even worse. Now, why GME caught the fancy of short sellers really depends on their individual analysis. However, due to the physical nature of its business and the absence of online presence, it would have made people conclude that it would be severely impacted during the pandemic and would have to shut down eventually.
So, what you're saying is given what you're saying in terms of lackluster performance even leading up to the pandemic, so there was no potential for the price to rise at all from
Well,
an intrinsic perspective.
okay, so that's a good question because while the meteoric rise in the hundreds of dollars of the share price is definitely a momentum play, and that, in my opinion, was unmoored from reality. But if you think about it, GameStop is the only major physical store dedicated to gaming in the US. It has a healthy market share as well. In the survey in the US, it was indicated that up to 25% of people buy their new games at GameStop and 40% buy their second-hand games there. It had already put in place a reboot plan. It was going to leverage on its legacy business and cut costs there. Secondly, it was planning to invest in reinventing itself as a premier gaming hub. within the thriving gaming industry, which is, I think, valued at $150 billion or something. So this was a high potential move, and their test stores in Oklahoma had done well. So it's not true that there was entirely no basis, for an investment in GameStop. If you've seen the movie The Big Short, you will know about this person called Michael Burry. Avinash, I think you mentioned it on our channel as well. So he made millions shorting the housing market in 2008. His fund is now called Scion. And Scion had invested in the GameStop in 2019 and had done well out of it. His investment had doubled in a year. That was before this recent rally, by the way. So if he still had GME in his portfolio, he would have made stupendous gains. So in short, no, there were people who believed that there was a basis, a fundamental basis for investment in GameStop, and had invested in it prior to this rally as well.
So what kicked off the interest in the stock?
So, okay, so let's see how it happened. Okay, so on the 12th of January, the stock was at $19. Then on the 13th of January, it jumped to $31, and this continued over the next 4 trading days. By the 21st, it was at $43. The next day, it jumped to 65, and the next after that to 76. Okay, and by 26th January, there had been a burst upwards on the share price up to $148. So, and it didn't stop there. And over the next trading days, as we saw, it reached $400 before pulling back to 320, and
From
now it's below 100.
$19. From
Sorry?
$19. From
Yeah,
19
from
bucks.
19 bucks, exactly. From 19 bucks, it went up to $400, and we're talking in less than a month. We're talking about in 2 or 3 weeks. So this is how this was a live sort of way in which you could see how this interest was getting generated and a momentum play was being put into place. The intraday volatility on it was phenomenal. Like, I mean, all of us are aware of implied volatility. We use it in Finvisage derivative prices all day. But you're all used to seeing implied vol numbers ranging between 5% for currencies to 40% for oil, or somewhere in the middle for others, right? But if you wanted to buy a call or a put option on GME stock, you were paying an implied vol of 300%. Now let that sink in for a bit. 300% was the implied volatility on these single stock options. So these were clear indications of a short squeeze on the stock.
What's a short squeeze?
Okay, so let me first step back and explain then, like, okay, who started this, right? So there's a Red subreddit on a community on Reddit called Wall Street Bets. And it's basically a forum on Reddit where retail investors get together and in a very profane way discuss stock ideas. Okay, it's a very aggressive sort of group of people that get together and discuss trading strategies, and they primarily gear those trading strategies around options. They ignore fundamentals entirely. So once Redditors on this forum realized that hedge funds were short, they started buying up the stock in bucket loads, which caused the price to rally. Now, like, we know what must have happened then, right? So the margin calls would have been triggered, and therefore these to cover up those margin calls, either the funds that were short had to cough up money, or they had to buy back the stock. If they bought back the stock, that would have crystallized their losses. But they had to cover their positions. So, but when they went to cover their positions, what happened? It's not like it's extremely liquid. So the stock rallied further, and that triggered more further stop losses. That spiral finally led to the stock rallying to those levels that we saw. That is a short squeeze. So it's like, if you think about it, if you think an analogy, it's like, trying to catch a train that is leaving the station. The sooner you realize there is no chance in hell that the train is going to stop, the better it is for you. If you're stuck on the train and want off, the sooner you get off, the better, and the other way around. Because in both cases, the later you leave it to, the more hurtful it will be.
Right. So why did the Redditors pick GME as the stock squeeze then?
And can I ask a related question?
Yeah.
Why has this not happened before with another stock? Because shorting's been happening all the time. Right?
Okay, brilliant.
Why has this not happened earlier?
No, brilliant. Okay, so why did they pick GME? So it got posted on GME on Reddit that GME was the most shorted stock. So there are disclosures that need to happen, basis which people can gauge how much is a short position in a stock. And there was a 140% short position on GME. Okay. What does that even mean? How can you short a stock more than the available float? Right? Yeah, there's lots of derivative positions that you can put in place, which will basically magnify the amount of using leverage. You can magnify the amount of short that you have on the stock. Okay, so that then got there was an avalanche of posts on GME or on the Reddit about GME, that this is a massively shorted stock. If we buy it all up, it will cause a short squeeze. People started to follow that. Secondly, then there was a research that came out by a very well reputed short seller called Citron Research. It sort of brought out a report saying that the price was overvalued and ripe for shorting. But that did the opposite on the Reddit board than it should have done. So it sort of put a momentum under the players on the Reddit board, and they continued to buy it even further, saying, okay, this is great. We need to create a further short squeeze. So it soon became a momentum trade. And there was indications, if you read the board, intricately, there were indications that this was sort of becoming an emotional trade where people were using this to express their angst against a set of people that were perceived to have done well out of the 2008 financial crisis, when these very retail investors suffered. So, I mean, that was the perception. Whatever is the reality, only data can tell us whether that was true or not, whether truly these people were hurt or not. So then the other question, Alice, that you said was why now, right? Why has this happened suddenly now? Why has the retail investor suddenly become this important? Why haven't short squeezes happened before? So short squeezes have happened before, but they have happened when one sophisticated investor was short squeezing another sophisticated investor, right? So, for example, on Herbalife, it was the name of a stock which was short squeezed heavily by a group of people, and one of the sophisticated investor lost out. But this was, I think, the first time when the retail investor became involved in this. And hedge funds, and typically retail is always discounted as flow which will never move the market, which will only follow the market. But this time it was yeah, Trip, sorry, you had a question?
Yeah, just you were going to answer the same. I was going to ask you, like, how has it happened that all of a sudden the retail investors, have become so important to be moving the market against the expectations of hedge funds who are traditional movers of the market?
Time and money. Okay.
Okay.
So first of all, time. Think about it. During the lockdown in the US, many young people were forced to stay at home, right? They lost their day jobs. They turned to trading for various reasons. Why? Tackle boredom, make some extra money, interest in the markets, mental stimulation, or something else. And um, what do they do with their money? So, and all Americans were receiving stimulus checks. Now, again, it's alleged that some of those stimulus checks found their way into the stock market. It can't be proved, or it's difficult to prove. But yes, there was this sudden influx of retail interest into the stock market because they had a bunch of time on their hands and they had available money in their hands as well.
So, how has options trading played a role in this, AJ?
Okay, so options trading has been very interesting in this because there are trading apps like Robinhood who
Mm-hmm.
allow retail investors to trade on single stock options. So people were buying call options on GME stock in place of the underlying stock. And not only retail, but large investors like Chamat Palhapati also joined in the call buying frenzy. He tweeted about this as well, and he did a very insightful interview on CNBC as well. So this sort of made options more prominent and sort of multiplied the interest on options as well. Now, what happened was these options were held till expiry by the option holders and then exercised. And they wanted to take delivery of the shares because they wanted to hold on to the shares and sell them later. And they were massively in the money on them. So think about the option writer, right? He or she had to go into the market, buy the shares, and transfer them to the call option buyer and exercised it. And when he went to buy the shares, that pushed the price of the share even higher.
Sorry, you mentioned an app, Robinhood.
Robinhood.
So, I mean, where do they come in into the scenario that played out over the last few weeks?
So Robinhood is a trading app in the US that it claims to democratize finance. It made available stocks and options to trade to users, to retail users, for zero commission. Now, and this sort of led to a growth in popularity of no commission brokers, and mobile, online trading potentially contributed to this growth of trading trends as well. Now, but Robinhood was in the news for all the wrong reasons. So they were in the news because they made lots of people very angry. And what did they do? Let's understand that. So let's first, to understand that, let's look at, first of all, slightly under the surface of Robinhood. So there is an introducing broker dealer called Robinhood Financial. That is the app that their customers use to trade. And Robinhood Financial processes these trades. Then there is a clearing broker dealer called Robinhood Securities that clears and settles the trades. So obviously on the 27th of Jan, as you saw, when there was a huge growth in the stock price, right? Robinhood saw a lot of activity. And they then received a margin file. They will there after the end of the day trading, there will be settlements that are happening, and then they received a margin file from the National Securities Clearing Corporation in the US, asking them to place a deposit of $3 billion. $3 billion as margin. Now, this was an unusually high request for capital, and think about it. At that time, Robinhood total funding raised in venture capital was $2 billion. So, I mean, let's first understand what is this $3 billion, right? What goes into calculating this deposit number? So VAR, we're familiar with VAR. VAR is a critical input of it, right? We're familiar with it. We calculate value at risk in Finvisage as well. You all know that there are three methods to calculate VAR. Now the NSCC uses the parametric method. To estimate volatility, which is the most important input in the formula, the NSCC can use any generally accepted portfolio volatility models. And they will take into account historical data as well, from an exponentially weighted average volatility estimation and an evenly weighted volatility estimation as well, using a look back period. Now, we know there was a huge increase in volatility in the GME stock, right? And it was going on since the 13th. So this would have definitely contributed to a higher volatility estimation. Since volatility has a large influence on the calculation of VAR, it's not difficult to see why they saw such a large demand for capital. The NSCC, however, enhances the VAR charge by including an additional bid-ask spread risk charge, on which acts as a multiplier. The bid-ask spread on stocks that were experiencing high volatility that day was a few dollars, not cents. So in addition, the NSCC also includes a margin liquidity adjustment charge, or the MLA. And the MLA charge is calculated to address the risk presented to NSCC when a member's portfolio, in this case Robinhood is a member, contains large net unsettled positions in a particular group of securities with a similar risk profile on a particular asset type. Now put these all together and the picture becomes clearer why Robinhood experienced such a high request for capital that day. Now, do I think it should have come as a surprise? No, definitely not. For a company doing what they do, this is their bread and butter. Scenario planning should have been carried out. Someone definitely dropped the ball, which then led to the subsequent controversies.
I think it is similar to how we run scenarios in our Finvisage app by changing the market and see how it impacts, right?
Absolutely. And any one in the market would have expected them to do that, especially since this volatility was happening since about 10 days, 15 days prior to the demand, right? So there was already an expectation, there was already an increased volatility in the market. And so anyone would have expected them to run these scenarios properly. So what they did after the 3 billion demand is also interesting. So they picked up the phone and called up the NSCC to see if the demand could be negotiated down. And now, what would have the NSCC done, right? So let's understand what the NSCC is as well. It's not a government institution. So we know about, in India, the Indian equivalent, whose also initials are also NSCC, is a wholly owned subsidiary of the National Stock Exchange. The NSCC in the US is a subsidiary of the DTCC, the Depository Trust and Clearing Corporation, which is owned by a consortium of banks and brokers. Right? So the NSCC is regulated by the Securities and Exchange Commission. So they negotiated with Robinhood and they decreased the demand to $1.4 billion. Eventually, they negotiated further and reduced it to $700 million.
I think Ellie is asking you a question as well.
Give me a minute. Yeah. Sorry, she's a bit
No,
excited in the
that's
morning.
cool. No, that's cool. Don't worry about it.
Sure, she's
Carry on.
interested, excited.
So,
Yeah.
700 million was the final demand that they had to place with NSCC. And I mean, I don't know the inner dynamics, but it would have been interesting to know how 3 billion came to 700 million. However, Robinhood raised $1 billion within 24 hours with their equity backers and paid this amount. But now they had a different problem. They had to come up with a strategy to manage the risk for the next trading day. Because now they have woken up. The volatility was not going away. And if they did nothing, there would be another massive demand eventually. So um, they were a bit late in realizing this. And if whoever was supposed to had done their job, they would have been better prepared for this. Anyway, so they decided to only allow position closing trades on stocks like GameStop and AMC and others who are contributing to this volatility. This would forcibly reduce their exposure, resulting in a reduction of request for capital. Now, this is interesting, and it's important to understand why they did this. They knew that this would almost exclusively hurt their users. So, some of you do trading in your free time, right? You will know more than anything how much of a nightmare it can be to be restricted in your ability to trade your open positions at will. And if Robinhood stands for democratization of finance, then why do the one thing that will hurt your customer base the most?
Okay, so if not the users of that app, then who is really Robinhood's customer?
Excellent. Yeah.
Incidentally, sorry, just before you jump into that, I was listening to what Trips was saying about doing scenario analysis. I think good case for us after FX and commodities to start doing equities on our system on Finvisage as well.
Yeah.
Yeah,
It's
equity
quite
support
interesting. Yeah.
it has been in the pipeline.
That's a fair point.
Absolutely. Yeah. So, Avinash, the customers of Robinhood are the hedge funds to whom it sells the customer flow. So, how does it make money? It makes money by selling users' trades to other large firms before they're actually executed. Those firms make money by effectively seeing what the retail investors on Robinhood are going to do before they actually do it and acting accordingly. Those firms are basically buying information that then informs their own trades. It turns out it's users more accurately. Their trading information that was turned into a product, and then they asked for payment from funds for information on this order flow.
Okay, so how does this really work?
Hmm, sure. So um, to ensure trades are commission free, trades are sold to market makers or large firms such as Citadel. Citadel Securities is Robinhood's largest customer, and affiliate Citadel LLC tried to bail out Melvin Capital after its GameStop short cost like that particular fund billions of dollars. Um, Market makers like Citadel execute those trades, sometimes at an inferior rate, and can use their privileged position to place themselves in the middle and make a profit. Crucially, in this arrangement, more trades and more volatility mean there's more for firms like Citadel to work with. So, I mean, I actually have an expert. I was expecting this question. So, I have an excerpt here from the Financial Times explaining how it works. Okay, so I'll just read it out to you. So, begin quote. Citadel Securities pays tens of millions of dollars for this order flow, but makes money by automatically taking the other side of the order, then returning to the market to flip the trade. It pockets the difference between the price to buy and sell, known as the spread. Easy access to the market against the backdrop of wild swings in prices have led to higher trading volumes for stocks and options this year, increasing the raw material Citadel Securities uses to turn a profit. At the same time, the rise in volatility has forced spreads wider, increasing the potential income for market makers. End quote. So now you can see how this has obviously caused many theories of collusion and less than honest activity by Robinhood to gain traction.
Tell me something, AJ. Beyond these theories of collusion that you talked about, is there anything else that everyone should be aware of? Anything else that is substantive and of importance as well?
So the we will only know the full details in the coming months. Okay, if the promised investigations by U.S. senators bear fruit, do anything. Incidentally, there is also a class action lawsuit that has been filed in New York against Robinhood, which could also bring to light information if it goes to a disclosure stage. However, um, if we look at the past, right, Citadel and Robinhood are not new to SEC investigations. So payment for order flow wasn't invented by Robinhood, but the company's technique differs from others who use it in the industry, in that it charges a percentage of the order spread. In 2020, payment of order flow made the company $90 million in revenue for the company in the first quarter, which was 70% of their total revenues. By the next quarter, and in one quarter, think about it, it had doubled to $180 million. So payment for order flow is a wonderful system that makes a lot of money for everyone involved except the consumer, the user of the app. In December, Robinhood was fined $65 million by the Securities and Exchange Commission for misleading statements and omissions in customer communications about its revenues. But there was a specific clause about around its payment of order flow basis, the process. The SEC found that customers were led to believe they were getting the best possible price for their orders, but were actually collectively deprived of $34.1 million because Robinhood chose to give their orders to firms that would give the company higher revenues rather than the best prices for consumers. In 2017, if you talk about Citadel, the SEC fined Citadel $22 million because its algorithms were shortchanging the retail investors whose order flows it was purchasing. So neither of these companies are strangers to SEC investigations. Yeah, Alice, you're mute.
Sorry, I didn't realize I was on mute. And is this now happening with other companies as well? Related to, that I think the question I asked earlier about if this was not happening earlier, now that the retail brigade has kind of figured out there's a play to do this, as much as this may have gotten carried away with emotion, but is this now becoming potentially a regular practice?
You mean with other stocks?
Yeah.
Yes. So at the time that GME volatility was happening, there were other stocks that came into play as well. So what Redditors did was they looked up other stocks that were heavily shorted and they started to bid up their prices too. So AMC, it's an American theater chain whose theaters have been closed. All of them have been closed since the pandemic, right? And that company saw its share price move higher by 70%. Now AMC was intelligent. They took advantage of it and they raised some investment by selling shares. And what they also did was they retired its convertible debt, and the holders of the debt were able to make substantial returns. Whereas still a couple of months ago, that debt was underwater and very unlikely to be repaid. So, and this goes back to the point that we were discussing earlier. Did the funds really come out so bad from this? Because there was this emotion going on or going around that this was retail getting back at those sophisticated investors who did well out of 2008. Now, in this particular AMC example, two funds, Silver Lake and Murdrick, they were the largest shareholders in AMC, and they held the convertible debt that I was just talking about. They made the trade of a lifetime from this. They converted that debt into equity, and then they sold that equity and crystallized hundreds of millions of gains on it. Another share that did well was Nokia. That suddenly saw a new lease of life. Its share price doubled. And now it's retraced its gains, but suddenly you could see Nokia being traded a lot as well. And then not just stocks. There was this an interest in silver suddenly, and silver price started to get squeezed, and silver suddenly had the largest rally it has ever had over one day. But there was a lot of chatter going on Reddit as well that this was not due to anything that retail was doing. This was just many hedge fund people had infiltrated the Reddit subboard, and they were bidding up the price of silver because these particular funds were long of silver. So there's now all sorts of such things also happening, which has affected this particular activity has affected other stocks as well.
Can I ask a more fundamental question at this stage?
Yeah.
So we talk about all these principles and rules of valuation which underline the how stocks should be, what stocks should be valued, etc. Right? I mean, there are the various discounting principles, etc. With the trends that these kind of trends in the market, do you see these as one-off, or do you see some of these principles of valuation changing, equity valuation? you know, getting affected by it all uh, in some way.
What do you what does other things? I mean, I think all of you also follow the stock markets, and we've been doing these valuation models in Finvisage for a while as well, so you're very well aware of it. So after this recent incident, Trips, Avinash, what do you guys think about what's going to happen to these traditional way of looking at equity stocks? You know, this fundamental analysis and this valuation, traditional valuation method of looking at stocks.
I believe it's going to change. It's going to also people are also not just going to look at the prices that are being listed on these indices. They're also going to spend more time and look at what the company really does, in the back end. What is the revenue system of these companies? What is that they're going to bring up in future? What are their product lines? So I think consumers, retail investors per se, will become more intelligent in that manner. They will be investigating a lot before deciding upon which stock to go with. And I believe there must be a lot of learnings for both of the parties. Let's look at those as well. But I believe the evaluations will now be changed. This is a wake up call for most of the investors and the hedge fund as well.
I think retail has found a way to sort of take advantage of momentum plays, which has not happened before. So what earlier momentum plays have been the bulk of the gains of momentum plays have gone to hedge funds who are able to control the flow and see the flow as well, right? But suddenly with this huge influx of retail that has happened in the markets, their momentum plays have become a lot more important and have taken precedence over fundamental analysis in some of these cases at least. So that is something also that needs to be taken into account, because uh, the fair value of that stock could be anything, right? I mean, if you fair value of GameStop, if you write a two-pager on it, it could come out to be a few tens of dollars or something. But if it stays on at 300 for too long, then you'll have to stop out at some point and crystallize those losses. So yeah, so I think that's one of the biggest learnings as well on this.
So as a retail investor, have a stop loss plan, I guess.
Yeah,
Always.
yeah, yeah, that's true, right? I think that's one of the learnings that we should be looking at as well from this.
My question, I have a question which is related to the point you just really made. Who do you think is going to have the last laugh? Someday the retail investors will sell the stocks that they are buying today, which has boosted up the whole price of it. So they have bought a lot of stocks, but at some point they will have to sell it to make money. Or the hedge funds, would have made money by then, and the real question is, it has become a race now. At some point someone is going to break. Question is, who do you guys think are going to break first? Will the hedge funds go bankrupt before the retail investors really make money and they get out of the market?
That's a good question. So there have all let's first look at what's happened already, right? There have already been some casualties in the market from this incident. Okay. So Melvin Capital, the fund that I mentioned earlier, I think it lost 100% of its value, and could potentially shut down from this trade. The total amount of losses that I read recently that have happened in the investment community so far are in the range of $70 billion amongst the funds that were sitting short. Now, I don't know if these losses had been crystallized or they were just marked to market, because if they were just marked to market, then with the drop in GME share price, they could have lessened as well. One of the most prominent funds, short sellers, Citron Research, that came out with short reports and would themselves short the stock as well after coming out with the report or before coming out with the report, they have permanently discontinued publishing short reports. They lost millions on the bet, and its editor also had to endure quite a bit of backlash. But as we discussed, right, the casualties will not only be restricted to funds. There will be definitely be casualties in retail as well. People who got into the momentum trade but didn't exit in time, they will hurt. And there is a huge risk in momentum trades as well if you don't have visibility or access to data like the funds do. Now, beginner's luck may not hold and could lead to losses which are like for retail investors, it's impossible to absorb those losses. The learning for short sellers is reinforced, of course, after this incident, that the profits, they are finite on this trade, but the losses don't have an upper limit here. And again, just coming back to the retail investor, I feel that he's finally understood that if something, and this is a learning I think that has been only buttressed by this incident, that if the platform is free, right, then the investor himself is the product. Then you are the product. So it's your data and information that is being used to earn revenues. So in this case, Robinhood's users are the product. It sells information about their trades instead. And it's far more lucrative and explains why it's willing to stop its users from trading, since they're not really a customer, they're just a data point. And therefore getting angry at Robinhood, right? And while all that was fine and justified, they should have known this before they got into trading with Robinhood, that if something goes wrong, they will be the first people who will have to who will be stopped from trading, who, or Robinhood will not take care of them, but will take care of their actual customers in that case. So, I mean, it goes back to the point that we keep making to our clients, right? There is no such thing as a free lunch. There are no such things as a no cost hedge. There are no such things as a riskless trade. There's no such thing as a friendly bank, right? So it's the same points that we keep making.
So just a final question. If this works out for retail investors, let us say, just in a worst case, in a best case scenario, or by some miracle, if it works out for them, will the term short sell be coming up to us way more frequently than what it is right now? Like, as we began this session by the question that short selling has a negative vibe to it, will it no longer be the case? Will people look at it as an opportunity now, and go out hunting for such stocks?
Yes and no, right? Because if you short selling, I think it'll take a while before short selling stops being sort of a negative word, being used negatively. But I think what might happen is that regulations might start to change and not allow leverage in these short sales. So I think what will happen is that the magnification of risk that happens, right, due to this leverage that can be done with the short sell, there might come regulation around this, right, which will help the retail person, which will help the genuine companies out there, right, in which is the key, which should be the aim out of this episode anyway. But the fact that now retail has joined in and retail is now benefiting from this as well, right? um, yes, I think it will go towards removing some sort of negative connotations around the word short selling, definitely.
Okay.
Brilliant. I think, should we wrap it up here? Are there any other questions?
That's it, Ajay.
Oh, that's
No,
Sounds good.
I'm good.
Brilliant, man.
Thanks, man.
So I think it's been an amazing experience discussing this with you. Thanks again, Trips, for coordinating it. And yeah, let's get back to work.
all right, guys.
All
Bye
right.
bye.
Thanks a lot.
Cheers.
Thank you.
Bye-bye.
Bye.